Hey everyone, in this video we're going to break down what's going on with United Parcel Service, UPS, and whether it might still be a good investment after its big price drop. UPS is a global logistics giant. They handle everything from package delivery to freight and supply chain management, operating in over 220 countries. Their business is split into three segments: U.S. domestic, international, and supply chain solutions. Most of their revenue, about 2/3, comes from domestic deliveries. In 2024, UPS brought in $91 billion in revenue. The U.S. domestic segment was the largest, contributing 66% of revenue but only 51% of operating profit. International and supply chain made up the rest with better margins. UPS stock has crashed from a high of $218 in 2022 to just $84 today. A big reason for the earlier rise was the COVID-era e-commerce boom. But now that the pandemic is behind us, those tailwinds have faded. And the biggest blow? Amazon, UPS's largest customer, is pulling back. Amazon's building out its own delivery network and plans to reduce its volume with UPS by more than 50% by mid-2026. That's huge. So what happens if Amazon cuts its volume by half? Based on 2024 numbers, UPS could lose around $6 billion in revenue. Even with $1 billion in cost savings, the domestic segment could go from profit to break even. The international and supply chain segments are more profitable, and combined, they might generate about $3 billion in net income. Now let's talk valuation. I ran a simple DCF model using the revised income assumptions. The result? A fair value of about $18.42 per share. That's way below the current market price of $84. In other words, based on current fundamentals, UPS looks overvalued. But maybe the market is pricing in strong future growth. If we do a reverse DCF working backwards to justify the $84 price, UPS would need to grow free cash flow by 16% per year for the next 5 years, and 12% for the 5 years after that. Not impossible, but given current conditions, very tough to achieve. There are also some structural concerns. Return on invested capital, or ROIC, has dropped from 27% in 2022 to just 14% now. That means UPS is generating less return on every dollar it invests. On top of that, their dividend payout ratio has been very high, between 80 and 97%, leaving little room for reinvestment. So let's wrap it up. We're looking at a potential $6 billion revenue loss, weakening domestic margins, a DCF fair value far below the current share price, and structural red flags like declining ROIC and limited reinvestment capacity. At $84, UPS doesn't offer a great risk-reward trade-off. Personally, I'll be staying away from the stock, at least for now. Let me know in the comments what you think. If I am wrong, I would like someone to tell me. After all, investing is about making money, not about boosting ego. Thank you for watching. Bye.